Right now, the market feels deceptively calm. After a really intense period of conflict, we've got this indefinite ceasefire. But for professional traders, this quiet isn't a signal to relax. Oh no, it's a massive window of opportunity. So let's unpack the strategies they're using to hedge what could be a very, very fragile piece.
And that quote right there, that's really the heart of this whole explainer. While the headlines are telling you that risk is coming off the table, the derivatives market is whispering a completely different story. See, the word indefinite doesn't mean permanent. All it does is introduce this profound uncertainty, creating a coiled spring of potential volatility just waiting for the right trigger. All right, so let's dig into this deceptive calm. On the surface, yeah, equity markets have started to price out the immediate risk. But if you look just beneath that surface, the core geopolitical and economic pressures, they haven't gone anywhere. And that creates this really dangerous mirage of stability. To really get what's happening now, you have to look at the last few weeks. The market has been on an absolute roller coaster. Just look at this timeline. A no-negotiation statement from Trump sends oil soaring. Failed talks tighten the blockade. Then, a false signal about the Strait of Hormuz causes a 10% crash in oil. Then, bam, the indefinite ceasefire causes the VIX, that's the market's fear gauge, to just fall off a cliff. But then, just one day later, the truce is shattered. This sequence just perfectly illustrates the hair-trigger environment we are in right now.
And this, right here, this highlights a critical disconnect. This diplomatic pause has not led to an economic one. Not at all. The blockade of the Strait of Hormuz is still fully in place, disrupting nearly a fifth of the world's entire daily oil supply. That fundamental economic shock is still there, it's still reverberating, even if the headlines have gone quiet. So this brings us to a really crucial point. That ceasefire news caused the VIX to plummet down into the 16 to 17 range. This is what traders call a volatility crush. It just means that implied volatility has fallen so sharply that options, the tools you use for hedging, have become artificially cheap. For a professional, this isn't a sign of safety. It's a fire sale on insurance right before a hurricane. The data here tells the real story. Just look at the oil VIX, the OVX. It's at almost 74. That's up nearly 79% over the year. That's screaming extreme, persistent risk in the energy market. But the most important number on this entire slide is that bottom one, the plus 0.82 correlation between Brent crude oil and the VIX. This is a massive, massive shift. It proves that in today's market, energy risk is equity risk. The fear in the stock market is now directly tied almost one-to-one with the price of oil. So this whole situation creates a huge divide. When you're faced with this kind of uncertainty, retail investors and professional trading desks, well, they behave in completely different ways. They have two totally divergent strategies. And let's be honest, here's the brutal truth. For most individual investors, hedging is just a fancy word for panic selling. When fear spikes, the gut instinct is to sell the winners, those high-flying tech and AI stocks, to raise cash and just get to the sidelines. But that's not a hedge. It's a surrender. You forfeit all potential upside if the market snaps back. This comparison just makes the difference crystal clear. On the one hand, the retail panic sell is totally fear-driven. Sure, it eliminates risk, but it comes at the cost of all future opportunity, and it probably creates a taxable event. On the other hand, the professional approach, using a protective put, is totally rule-based. It has a direct cost, yeah, but it lets you stay in the market, keeping all your upside while putting a hard floor under your downside. One is an emotional reaction, the other is a calculated mechanical strategy. So what is a protective put? Seriously, think of it exactly like an insurance policy for your portfolio. Let's say you own an ETF that tracks the NASDAQ 100. You then go and buy a put option on that same ETF. That little contract gives you the right, but not the obligation, to sell your ETF at a predetermined price, no matter how far it falls. You're just paying a small premium to protect your capital. And that right there is the real magic of this strategy. You don't have to guess the next headline, you don't have to time the market, you can stay invested in those powerful long-term trends like the AI revolution while knowing your portfolio is completely protected from a catastrophic drop caused by some geopolitical shock. You get to participate in the upside with your downside totally capped. Okay, so a protective put is kind of the cornerstone, the 101 for professionals. But institutional desks, they go even deeper. They use more advanced strategies to manage not just the direction of the market, but the very dynamics of risk itself. So now we're moving beyond simple bets on direction and into managing the dynamics of risk. Let's start with gamma hedging. This is about controlling the rate of change of your risk. Think about it like this. Imagine you're driving a car and the brakes get more sensitive the harder you press them. If you don't manage that, a small tap could send you into a terrifying skid. In markets, bad gamma management forces you to sell more and more into a falling market, basically accelerating your own crash. Then you've got convexity. This is about structuring your portfolio so it actually becomes your ally in a crisis. A portfolio with positive convexity naturally tells you to buy when prices are low and sell when they're high, acting like an automatic stabilizer. And finally, you've got this special tactic, the ceasefire spread, which is designed to weaponize the exact calm that we're seeing right now. So how does this ceasefire spread actually work in practice? Well, it's a pretty brilliant piece of trade construction. You use the calm period, that VIX crush, to buy cheap, longer-term insurance in the form of VIX call options. Then you pay for that insurance by selling expensive, shorter-term options that will probably expire worthless if the ceasefire holds. But the real target here is a weekend headline. A ceasefire breach on a Saturday, when the markets are closed, can cause a massive gap up in volatility at Monday's open, making that long-term insurance pay off spectacularly. Okay, so all of this sounds great in theory, right? But does the data actually back it up? Does this volatility time bomb really explode when these ceasefires end? Let's take a look at the evidence. And here it is. This is the whole thesis in a single chart. During the quiet period, the VIX gets crushed down to around 16. Complacency completely sets in. Then, when the ceasefire inevitably breaks, the VIX doesn't just go up, it explodes, more than doubling to 35. This is the payoff event that these professional hedging strategies are designed to capture. And let's put some hard numbers on that. A minor breach, maybe a few shots fired, that might cause a 15 to 20% pop in volatility. But the real tail risk event, the one that keeps risk managers up at night, is an attack on global energy infrastructure. If that happens, the data suggests volatility can expand by over 100%. The insurance you bought during the quiet lull suddenly becomes priceless. And this brings us right back to the most important number of this entire discussion, plus 0.82. This is the unbreakable link in the market today. A spike in oil prices caused by a ceasefire breach won't just be an energy story. It will be a stock market story. This incredibly high correlation guarantees that a geopolitical shock in the Strait of Hormuz will be felt immediately on Wall Street. There's no escaping it. All right, we've laid out the problem, we've looked at the tools, we've checked the data. Let's pull all of this together into a clear, actionable framework for how you manage risk in this unique environment. So here it is, the professional playbook in 3 simple steps. First, you exploit the calm. When the VIX is cheap, that's your signal to buy insurance. Second, you manage the complex risks. Go beyond simple puts and get a handle on your gamma so you're not forced to sell at the worst possible moment. And third, you structure your trades to specifically profit from the most likely catalyst, a sudden, violent, weekend news event that shatters the calm. So the crucial takeaway is this professional philosophy. This isn't about fortune-telling, it's not about claiming to know what President Trump or Iran will do next. It's about recognizing a structural risk, that ongoing blockade, and using the market's temporary complacency to prepare for a predictable type of event, a sudden, massive spike in volatility. It's all about preparation, not prediction. And this really is the question you should be asking yourself. The surface might look calm, the headlines might be optimistic, but those underlying risks haven't disappeared. They've just been temporarily forgotten. When the market is quiet, it's so easy to get complacent. But as we've just seen, that quiet is often just the ticking of a volatility time bomb. The real question is, are you prepared for it?